first topic for today is non-refundable credits. A non-refundable credit is a dollar-for-dollar reduction of the tax liability. A non-refundable credit can only reduce the tax liability to zero. For example, a taxpayer has a tax liability of $1,000 and a non-refundable credit of $1,200. Tax liability then becomes zero and the remaining $200 is lost. Non-refundable credits will appear on Schedule 3 of the 1040, and then they go to line 20 of the 1040. Let's talk about the non-refundable credits. The common credits that our taxpayers will have include foreign tax credit, credit for the child and dependent care expense, and we don't want to confuse that with the child tax credit, which we will talk about a little later. Education credits on line 3, retirement savings contributions credit, line 4, and line 6, other credits, which we rarely see. And again, this rolls up to the 1040, page 2, line 19 and 20. The first credit that we will talk about is the child and dependent credit. The credit may be claimed by taxpayers who, in order to work or look for work, pay someone to take care of their qualifying person. Child and dependent care credit expenses really involve 5 tests: the qualifying person test, the earned income test, the work-related expense test, the joint return test, and the provider identification test, which we will cover individually. Who is a qualifying person? A qualifying child who was under the age of 13 when the expenses were incurred and who can be claimed as a dependent. Now, if the child turns 13 in the middle of the year, then the qualifying expenses up until that age would be qualifying expenses. For instance, if the child turned 13 in April, expenses related to child care, qualified expenses related to child care could be taken for those first 3 months. Also, any person who was incapable of self-care whom the taxpayer can claim as a dependent or could have been claimed as a dependent except the person had gross income of more than $4,300 or filed a joint return, or that the taxpayer or spouse, if married filing jointly, could be claimed as a dependent on someone else's 2020 return, or a spouse who was physically or mentally incapable of self-care. The definition of incapable of self-care is persons who can't dress, clean, or feed themselves. Also persons who must have constant attention to prevent them from harming themselves or others. The qualifying person must live with the taxpayer more than 1/2 the year. Publication 17 discusses some other sections or special rules regarding divorced or separated parents or parents who live apart. What are qualifying work expenses? Expenses must be paid for the care of the qualifying person to allow the taxpayer and spouse, if married, to work or look for work. The care includes the cost of services for the qualifying person's well-being and protection. Expenses to attend kindergarten or higher grade aren't an expense for care. So in other words, if the child is going to a private school, then the private school the tuition would not be considered as a qualified expense. However, if after school they receive after school daycare, then that will be deductible. And typically, when this situation occurs, the provider breaks that down for the taxpayer. Also, expenses for summer day camp are qualifying, but those for overnight camp aren't. And we typically see this with like sports camps, football, basketball camps, where the child actually stays at a facility overnight. Then those expenses would not be considered as qualifying expenses. All of this information can be found on page G9 of the 4012. The information that I just covered addresses qualifying person tests, earned income tests, work-related expense tests, joint return tests. Also, we did not talk about the provider identification test. And what that says is the provider must provide a tax identification number, whether it's a Social Security number or for an individual or a employer's identification number for a business. The credit ranges from 20% to 35% of the taxpayer's expenses. The percentage is based on the taxpayer's earned income and adjusted gross income. The amount of the credit cannot be more than the amount of income tax on the return. It can reduce an individual's tax to zero, but it will never give the taxpayer a refund. Some taxpayers receive dependent care benefits from their employers. Employer-provided dependent care benefits appear in the taxpayer's Form W-2, Box 10. All taxpayers who receive employer-provided dependent care benefits are required to complete Form 2441, Part 3, to determine if they can exclude all or part of these benefits from their taxable income. Now, there is a limitation of qualifying expenses. The credit is limited to $3,000 for one qualifying person or $6,000 for two or more qualifying persons. The Child and Dependent Care credit will appear on Form 2441, and TaxSlayer will automatically complete this form based on the information that you have input into the program. And page G-1 shows what the credits will look like for all of the credits in TaxSlayer, so you'll know how to navigate through that. You would click on the federal sections, deductions, and then credit menu. And again, I want to point out about the provider identification test. Part 1 must be completed, where you list the person's or business name, its address, and the SSN or the employer's identification number, and of course the amount that was paid. But again, TaxSlayer will automatically populate this based on the information that you have input into TaxSlayer. If you have any questions, make sure you put them in the chat. Okay, we're going to move on to another non-refundable credit, and that's the education credit. There are basically 3 credits that you can get. The American Opportunity Credit, which is up to 40% is refundable. The Lifetime Learning Credit, and the tuition and fees deduction. We talked about the tuition and fees deductions already in adjustments. We want the taxpayer to take the credit that will be the most lucrative for them. And that's generally the American Opportunity Credit. However, the American Opportunity Credit, the guidelines are more stringent. Taxpayers can take education credits for themselves, their spouse, and or dependents claimed on the tax return who were enrolled at or attended an eligible post-secondary educational institution during the tax year. What is an eligible institution? An eligible institution is generally any accredited public, nonprofit, or private college, university, vocational school, or other post-secondary institution eligible to participate in a student aid program administered by the United States Department of Education. Now, if you'll turn to page J5 of the 4012, it outlines the guidelines for the American Opportunity Credit. And again, the American Opportunity Credit generally is the most lucrative credit for the taxpayer, but it does have some stringent guidelines, particularly up to $2,500 of the credit per eligible student. So if the taxpayer has 3 kids in college, then they could get up to $2,500 for, they could get up to $2,500 for each child, unlike the other credits. There are income limitations, $180,000 if married, filing jointly, $90,000 if single, head of household, or qualified widower. Again, 40% of the credit may be refundable, and we'll talk about that a little later. The rest is non-refundable. It just reduces the income tax liability, but never below 0. It's available only if the student had not completed the first 4 years of post-secondary education before 2020. So a person that was in a graduate program would never be able to take a non-refundable credit. Available only for 4 tax years per eligible student, including any years the Hope credit was claimed. Student must be pursuing a program leading to a degree or other recognized education credential. Student must be enrolled at least half-time for at least 1 academic period beginning during 2020, or the first 3 months of 2021 if the qualified expenses were paid in 2020. As of the end of 2020, the student had not been convicted of a felony for possessing or distributing a controlled substance. Tuition, required enrollment fees, and course materials that the student needs for a course of study, whether or not the materials are bought at the educational institution as a condition of enrollment or attendance. Payments made in 2020 for academic periods beginning in 2020 or beginning in the first 3 months of 2021. Filers and students must have a tax identification number by the due date of their tax return, of the 2020 return, including extensions. You must provide the educational institution's employer's identification number or on your form 8863, which is the education credits. And this form is automatically populated for you. Now, there is a time when part of the credit is not refundable, and that is if 1, taxpayer claiming the credit is A, under age 18, or B, age 18 at the end of the year, and their earned income was less than 1/2 of their own support, or C, a full-time student over 18 and under 24, and their earned income was less than 1/2 of their own support. And 2, the taxpayer has at least one living parent. And 3, taxpayer doesn't file a joint return. If you have any questions, again, be sure that you put them in the chat. Now, the credits that we're talking about now will appear on Schedule 3, Line 3. The next credit that we want to talk about is the Lifetime Learning Credit. And these guidelines are less restrictive than the American Education Opportunity Credit. Okay, let's look at the Lifetime Learning Credit. You can only take up to $2,000 credit per return, unlike the American Opportunity Credit, where you can get up to $2,500 for each eligible student. There are some income limitations based on filing status. $138,000 if married filing jointly, $69,000 if single, head of household, or qualifying widower. What that means is if the incomes are above that, then they won't qualify for the credit. It is non-refundable, the entire credit. The credit is limited to the amount of tax you must pay on your taxable income. It's available for all years of post-secondary education and for courses to acquire or improve job skills. So this could include the graduate students. Available for an unlimited number of tax years. Again, graduate students. Student does not need to be pursuing a program leading to a degree or other recognized education credential. Available for one or more courses. Felony drug convictions do not make the student ineligible. Tuition and required enrollment fees, including amounts required to be paid for the institution for course-related books, supplies, and equipment. And again, similar to the American Opportunity Credit, payments made in 2020 for academic periods beginning in 2020 or beginning in the first 3 months of 2021. And you can find all of this information under page J5 of the 4012. Again, if you have any questions, please be sure that you put the information or the question in the chat. There's a new provision because of the CARES Act, and it says that emergency financial aid grants under the CARES Act is not includable in gross income. Taxpayers cannot claim any deduction or credit for expenses paid with the grant, including the tuition and fees deduction, the American Opportunity Credit, or the Lifetime Learning Credit. There is a source document that the taxpayer must present in order to take these credits, and it is a 1098-T. This form, of course, would list the taxpayer's name along with their identification number, as well as the employer's identification number. So information that you input into TaxSlayer comes from this form. You want to pay close attention to number 1 and number 5. And the reason being is if the qualified tuition and related expenses or say $5,000 and they received a scholarship or a grant for $4,000. Well, that $5,000 has to be reduced by the scholarships. So in actuality, the taxpayer would be only entitled to $1,000 of qualified expenses. So we want to pay close attention to those two boxes, because again, scholarships or grants reduces the amount that the taxpayer can claim. All of the credits indicated either the student had to be half-time student, or they had to be, or they were a graduate student. So where do you get this information from other than talking to the taxpayer? You would get that from line 8 and line 9. Typically, the institution will check line 8 if the student was a half-time student, which is a qualification for the American Opportunity Credit, and check if it's a graduate student or not. A graduate student would not be eligible for the American Opportunity Credit. But once again, when you input all this information into TaxSlayer, it's going to automatically complete that form. Let's take a look at J-8. On that page, this is what of the 4012, this is what the screen will look like in TaxSlayer that you will need to navigate through. For example, you enter the eligible student's Social Security number, or you select it, it's a drop-down box. Then you would indicate whether you're taking the American Opportunity Credit, the Lifetime Learning Credit, or tuition and fees deduction. Note, TaxSlayer will allow you to compare the educational benefits and determine the largest refund using each benefit. And again, we want the taxpayer to take the benefit that's most advantageous to them. And then the next tab, you would enter the qualifying expenses. And remember, I said you must have an identification number for the college or the educational institution. You see where you would enter their name, the address, and so forth. Then the next page, J-9, it continues with information that you have input from the 1098-T. Did the student receive the form 1098-T from the institution? Did the student receive form 1098 from the institution for 2019 with box 2 filled and box 7 checked? And that's why it's so critical, because if box 7 is checked, then the expense or the qualified expense has to be reduced. Okay, the next shows where the identification number goes for the institution. And all of these questions are must be answered in order for the credit to be taken. Again, we talked about the half-time. That's there. Whether the student has been convicted of a drug or a felony drug conviction. Okay. But again, this is just so that you can get a feel for what the screen will look like in TaxSlayer. Okay, we just covered those. More from the TaxSlayer screen. J-9 Are you eligible for the refundable portion of the American Opportunity Credit? Remember, I said there were some criteria where none of the credit would be refundable. So we need to complete that section. Okay, that pretty much wraps up the education credits. And again, the education credits would appear on Schedule 3 according to a specific line. Okay, the next credit we want to talk about is the foreign tax credit. This is a non-refundable credit, which means that it will not put any money in the taxpayer's pocket. It appears on Schedule 3, Line 1. U.S. citizens and residents compute their U.S. taxes based on their worldwide income, and I'm sure you covered that under the income section. Taxpayers who pay taxes to a foreign country or United States possession may be entitled to a credit on their U.S. taxes. This is generally seen on Forms 1099 INT, Form 1099 DIV, or Schedule K1. And again, this will appear on Schedule 3, Part 1, Line 1. Once you have input that information, that's why it's so critical that you input everything into all of the items into the source documents, because TaxSlayer will automatically pick this up. Any questions? Please put them into the chat box. The next non-refundable credit that we will talk about is the child tax credit. Now, this is different from the dependent and child care credit, so don't get the two confused. If you turn to G-2 of the 4012, it contains information regarding the child tax credit. Now, this is a credit intended to reduce the tax. This part of the credit isn't refundable. The credit is up to $2,000 per qualifying child. And here again, based on the information that you have input into TaxSlayer, TaxSlayer automatically computes this credit. Who is a qualifying child? A qualifying child is under the age 17 at the end of the tax year, a U.S. citizen or U.S. national or resident alien of the United States, and tab L of this book discusses resident or non-resident alien. Child must be claimed as your dependent, must be your A, son or daughter, adopted child, stepchild, eligible foster child, or descendant of any of them. B, brother, sister, half-brother, half-sister, stepbrother, stepsister, or a descendant of any of them, for example, your niece or your nephew. Didn't provide over half of his or her own support. Lived with the taxpayer for more than half of the tax year, and there are some exceptions to that we'll talk about a little later. Must have a Social Security number that is valid for employment issued before the due date of the return, including extensions. So, taxpayers or a child that does not have a valid Social Security number will not be able to take this credit. the parent would not be able to take this credit. And it gives some definitions of what a national is, and also it refers you to tab C, dependents for the rules governing who may be claimed as a dependent. And we've already talked about that. Caution, if the taxpayer is able to claim the dependent under the rules of divorced and separate parents, he or she is the only parent entitled to claim the child tax credit or additional child tax credit. And I did not mention it, but we will talk about it a little later. Related to the child tax credit, there is an additional child tax credit, which is a refundable credit that we will talk about a little later. And if you'll look at G-1, that is the screen that you would enter all of the credits that we've been talking about. In addition to the child tax credit, or just before we get to that, I want to direct you to page G-3. This contains some information, or it is a screening sheet that you can use to help you determine what the child tax, if the taxpayer is eligible for the child tax credit. Also, there's more information on G-4, and this addresses the credit for other dependents. There is a $500 credit for other dependents who do not qualify for the $2,000 child tax credit. The dependent must be a U.S. citizen, U.S. national, or resident of the United States. The dependent must have a valid identification number, an adoption tax identification number, an I-10 or employer tax identification number, or a SSN. Unlike the child tax credit where you have to have a Social Security number. The $500 refundable credit is available for dependents who don't qualify for the child tax credit, such as children who are age 17 above, dependents with other relations, such as an elderly parent, or again, as I mentioned earlier, children who do not have a valid SSN. Taxpayers cannot claim this credit for themselves or a spouse if married filing jointly. So it's limited to a qualified child based on the definitions that we gave earlier. There is a caution. Dependents who are not U.S. citizens or U.S. nationals but are residents of Canada or Mexico do not qualify for either the child tax credit or the credit for other dependents. There's also a note, if previously disallowed, see Form 8862, information to claim certain credits after disallowance in tab I, earned income credit. If this credit has been disallowed in a previous year, then the taxpayer gets a letter from the Internal Revenue Service, and that information must be entered on Form 8862. How do you know if it's been disallowed? Of course, you would ask the taxpayer, but then Part 5 of the intake sheet, the 13614C, it addresses this. And that's why it's so critical that we look at all of the sections on that form so that we can ensure we are preparing an accurate and complete tax return. This also will apply to the earned income credit, which we'll talk about a little later. If you have any questions, be sure to put them into the chat. The next credit that we will talk about is the retirement savings contribution. The retirement savings contribution credit is a non-refundable credit. Eligible taxpayers may claim if they made a qualifying contribution to a retirement plan. If the contribution is tax deductible, such as a traditional IRA, the taxpayer receives the benefit of the tax deduction and a tax credit. This is considered a double benefit and is rarely allowed. We talked about it being an adjustment earlier. Contributions to non-tax deductible accounts, such as a Roth IRAs, can qualify the taxpayer for the credit as well. This credit would go again on Schedule 3, Part 1, Line 4. This chart, G-15, outlines the guidelines for the retirement savings contribution credit, which again is a non-refundable credit. And it is calculated using the following percentages. But no worries, TaxSlayer will automatically compute this based on the information that you have input into TaxSlayer. For instance, if a taxpayer made $20,000, then they would fall between the $19,500 but not over $21,250. Their percentage would be 0.5, head of household 0.5, single 0.2. But again, no worries, TaxSlayer is going to automatically compute this for you. Any questions, please be sure you put them into the chat. The next credit that we want to talk about is the elderly or disabled credit. And we don't see a lot of this because of the income limitations. But individuals who qualify for the elderly or the disabled credit are age 65 or older, or under age 65, retired on permanent and total disability, receiving taxable disability income, and under the mandatory retirement age their company has set. And remember I said that we don't see a lot of this because of the income limitations. This page, and you can find it in G-16 of the 4012, outlines the income limits. For instance, if you are single, head of household, or qualifying widower with dependent child, your adjusted gross income, or your AGI, can't be more than $17,500, or the total of your taxable Social Security and other non-taxable pension, annuities, or disability income is equal to or more than $5,000. And this chart breaks it down based on filing a joint return with and where maybe one spouse qualifies and the other one does not. And of course, married filing separately, we do not address at all. There is a caution. Be sure to include the taxpayer's total Social Security benefits, regardless of the taxability, to ensure the correct calculation of the credit. The software does not calculate this credit automatically. If the taxpayer appears to qualify the credit, then you need to go through the navigation path on TaxSlayer and answer those questions. Okay. We have completed all of the non-refundable credits, and these non-refundable credits included foreign tax credit, credit for child and dependent care expenses, education credits, retirement savings contribution credit, and other credits. We're now ready for a poll question. Bob was a full-time student and a fifth-year senior. He has only claimed the American Opportunity and Hope credit in 3 earlier years. Does he qualify for the American Opportunity credit? Yes or no? Please be sure that you use all of your resource materials so that you can come up with the correct answer. And for the UTD students, please make sure you answer this question because the information will be provided to your instructor. The poll is closing. If you answer yes, then you are correct. Bob qualifies for the American Opportunity Credit because he only claimed the credit in 3 previous tax years. Even though he's in his 5th year, he had only taken the credit for the previous 3 tax years, and he doesn't have a degree. He hasn't completed his degree. So, yes is the correct answer.